Fixed income security definition, types, and examples. What are fixed income securities? A fixed income security is an investment that provides a return through fixed periodic interest payments and the eventual return of principal at maturity. Unlike variable income securities, where payments change based on an underlying measure such as short-term interest rates, the returns of a fixed income security are known. Key takeaways. Fixed income securities provide investors with a stream of fixed periodic interest payments and the eventual return of principal at maturity. Bonds are the most common type of fixed income security. Different bonds have different terms and credit ratings assigned to them based on the financial viability of the issuer. The U.S. Treasury guarantees government fixed income securities, making these very low risk but relatively low return investments. 117. Fixed income security. Understanding fixed income securities. Fixed income securities are debt instruments that pay a fixed amount of interest in the form of coupon payments to investors. The interest payments are commonly distributed semi-annually, and the principal is returned to the investor at maturity. Bonds are the most common form of fixed income securities. A bond is an investment product corporations and governments issue to raise funds to finance projects and fund operations. Corporate and government bonds have various maturities and face values. The face value is the amount the investor will receive when the bond matures. Corporate and government bonds trade on major exchanges and usually are listed with $1,000 face values, also known as the par value. Companies raise capital by issuing fixed income products to investors. Credit rating of fixed income securities. Bonds are assigned different credit ratings based on the financial viability of the issuer. Credit ratings are part of a grading system performed by credit rating agencies. These agencies measure the creditworthiness of corporate and government bonds and the entity's ability to repay these loans. Credit ratings are helpful to investors because they define the risks involved in investing. Bonds can either be investment grade or non-investment grade bonds. Investment grade bonds are issued by stable companies with a low risk of default and therefore have lower interest rates than non-investment grade bonds. Non-investment grade bonds, also known as junk bonds or high-yield bonds, have lower credit ratings due to a probability of default by the issuer. Investors receive a higher interest rate from investing in junk bonds for assuming the higher risk of these debt securities. Types of fixed income securities. Treasury notes. Treasury notes, T-notes, are issued by the U.S. Treasury and are intermediate term bonds that mature in 2, 3, 5, or 10 years. T-notes usually have a face value of $1,000 and pay semi-annual interest payments at fixed coupon rates or interest rate. The interest payment and principal repayment of all treasuries are backed by the full faith and credit of the U.S. government, which issues these bonds to pay debt. Treasury bond. The U.S. Treasury also issues Treasury bonds, T-bond, which mature in 30 years. Treasury bonds typically have par values of $10,000 and are sold on auction on the website Treasury Direct. 1. Treasury bills. Short-term fixed income securities include Treasury bills. The T-bill matures within 1 year from issuance and doesn't pay interest. Instead, investors buy the security at a lower price than its face value or a discount. When the bill matures, investors receive the face value amount. The interest earned or return on the investment is the difference between the purchase price and the face value amount of the bill. Municipal bond. A municipal bond is issued by states, cities, and counties to fund capital projects, such as roads, schools, and hospitals, commonly sold with a $5,000 face value. The interest earned from these bonds is exempt from federal income tax. The interest earned on a muni bond may be exempt from state and local taxes if the investor resides in the state where the bond is issued. The muni bond has several maturity dates in which a portion of the principal comes due in intervals until the entire principal is repaid. Certificate of deposit. A bank issues a certificate of deposit CD. In return for depositing money with the bank for a predetermined period, the bank pays interest to the account holder. CDs have maturities of less than 5 years and typically pay lower rates than bonds, but higher rates than traditional savings accounts. AAE CD carries Federal Deposit Insurance Corporation (FDIC) insurance up to $250,000 per account holder. 2. Corporate bonds. Corporate bonds are debt securities issued by companies to raise funds. Unlike company stocks, bond investors have no voting rights or equity in the company. Bonds are classified based on their maturity period. Short-term bonds are held for less than 3 years, medium term for 4 to 10 years, and long term for more than 10 years. Bonds are classified as investment or non-investment grade depending on the company's credit rating. Preferred stock. Companies issue preferred stock that provides investors with a fixed dividend, set as a dollar amount or percentage of share value on a predetermined schedule. Interest rates and inflation influence the price of preferred shares, and shares have higher yields than most bonds due to their longer duration. Advantages and disadvantages of fixed income securities. Advantages. Fixed income securities provide steady interest income to investors, reduce risk in an investment portfolio, and protect against volatility or fluctuations in the market. Equities are traditionally more volatile than bonds, so investors may allocate a portion of their portfolios to fixed income investments to reduce their risk level. Fixed income securities are also available in mutual funds and exchange-traded funds, ETFs. The prices of bonds and fixed income securities increase and decrease. Although the interest payments of fixed income securities are steady, their prices are not guaranteed to remain stable throughout the life of the holding. If investors sell a fixed income security before maturity, gains or losses are based on the difference between the purchase price and the sale price. The U.S. Treasury guarantees government fixed income securities considered safe haven investments. Corporate bonds depend on the financial viability of a company and have a higher risk of default than government bonds. However, corporate bonds are more likely to be repaid if a company declares bankruptcy, since bondholders will be repaid before common stockholders. Disadvantages. Fixed income securities commonly have low returns and slow capital appreciation or price increases. The initial principal amount is often inaccessible, particularly with long-term bonds with maturities greater than 10 years. Fixed income securities provide a fixed interest payment regardless of where market interest rates move. An investor that purchased a bond paying 2% per year will lose income if market interest rates rise above 4%. Inflation may erode the return on fixed-rate securities if the inflation rate is higher than the interest rate of the fixed income instrument. All bonds have credit or default risk, since the securities are tied to the issuer's financial viability. Investing in international bonds can increase the risk of default if the country is economically or politically unstable. Fixed income securities provide steady interest income to investors throughout the life of the bond. Fixed income securities are rated by credit rating agencies. Fixed income securities usually have less price volatility risk. Fixed income securities such as U.S. Treasuries are guaranteed by the government. The issuer can default on making the interest payments or paying back the principal. Fixed income securities typically pay a lower rate of return than other investments. Inflation risk can be an issue if prices rise by a faster rate than the interest rate on the fixed income security. Market interest rates may rise higher than the rate on a fixed income security. Real-world example. Treasury bonds are long-term bonds with a maturity of 30 years. T-bonds provide semi-annual interest payments and usually have $1,000 face values. A 30-year Treasury bond was issued on February 15, 2023, with a rate of 3.625. Investors are paid $36.25 on their $1,000 investment each year. The $1,000 principal is repaid in 30 years. 1. A 10-year Treasury note was issued on February 15, 2023, with a rate of 3.5. The bond also pays semi-annual interest payments at fixed coupon rates and usually has a $1,000 face value. Each bond would pay $35 per year until maturity. 1. How can you invest in fixed income securities? Investors can purchase U.S. government fixed income instruments through Treasury Direct. 1. Corporate bonds or bond funds can be purchased through a financial broker. Certificates of deposit are purchased through financial brokers or banks. What are the risks of investing in fixed income instruments? Fixed income instruments require investors to commit their money for an extended period, sometimes up to 30 years. As market conditions change, the market interest rate may exceed the fixed income rate of the security, causing a loss to the investment. Inflationary pressures can also affect the market value of fixed income securities. What does it mean to default on a fixed income security? Default is the failure to make required interest or principal repayments on a debt, whether that debt is a loan or a security. Individuals, businesses, and even countries can default on their debt obligation. The bottom line: a fixed income security is an investment that provides a steady interest income stream for a certain period. Types include government bonds, corporate bonds, or fixed income ETFs. Fixed income securities are rated by credit agencies that assess the default risk for investors. These investments typically pay a lower rate of return than other investments. Fixed rate bond definition and interest rate risks. What is a fixed rate bond? A fixed rate bond is a bond that pays the same level of interest over its entire term. An investor who wants to earn a guaranteed interest rate for a specified term could purchase a fixed rate bond in the form of a treasury, corporate bond, municipal bond, or certificate of deposit. Because of their constant and level interest rate, these are known broadly as fixed income securities. Fixed rate bonds can be contrasted with floating or variable rate bonds. Key takeaways: a fixed rate bond is a debt instrument with a level interest rate over its entire term, with regular interest payments known as coupons. Upon maturity of the bond, holders will receive back the initial principal amount in addition to the interest paid. Typically, longer-term fixed-rate bonds pay higher interest rates than short-term ones. Understanding fixed-rate bonds. A fixed-rate bond is a long-term debt instrument that pays a fixed coupon rate for the duration of the bond. The fixed rate is indicated in the trust indenture at the time of issuance and is payable on specific dates until the bond matures. The benefit of owning a fixed-rate bond is that investors know with certainty how much interest they will earn and for how long. As long as the bond issuer does not default or call in the bonds, the bondholder can predict exactly what his return on investment will be. A key risk of owning fixed-rate bonds is interest rate risk, or the chance that bond interest rates will rise, making an investor's existing bonds less valuable. For example, let's assume an investor purchases a bond that pays a fixed rate of 5, but interest rates in the economy increase to 7. This means that new bonds are being issued at 70, and the investor is no longer earning the best return on his investment as he could. Because there is an inverse relationship between bond prices and interest rates, the value of the investor's bond will fall to reflect the higher interest rate in the market. If he wants to sell his 5 bond to reinvest the proceeds in the new 7's bonds, he may do so at a loss, because the bond's market price would have fallen. The longer the fixed-rate bond's term, the greater the risk that interest rates might rise and make the bond less valuable. If interest rates decrease to 3, however, the investor's 5 bond would become more valuable if he were to sell it, since a bond's market price increases when interest rates decrease. The fixed rate on his bond in a declining interest rate environment will be a more attractive investment than the new bonds issued at 3. Other considerations. An investor could reduce his or her interest rate risk by choosing a shorter bond term. He would probably earn a lower interest rate, though, because a shorter-term fixed-rate bond will typically pay less than a longer-term fixed-rate bond. If a bondholder chooses to hold his bond until maturity and does not sell it on the open market, he will not be concerned about possible fluctuations in interest rates. The real value of a fixed-rate bond is susceptible to loss due to inflation. Because the bonds are long-term securities, rising prices over time can erode the purchasing power of each interest payment a bond makes. For example, if a 10-year bond pays $250 fixed coupons semi-annually in 5 years, the real value of the $250 will be worthless today. When investors worry that a bond's yield won't keep up with the rising costs of inflation, the price of the bond drops because there is less investor demand for it. A fixed-rate bond also carries liquidity risk for those investors who are considering selling the bond before its maturity date. This risk occurs when the spread between the bid price and ask price of the bond is too wide. If this occurs and the bondholder is asking ask price for more than investors want to pay bid price, then the original holder may be placed in a scenario whereby they sell the security for a loss or significantly reduced rate, thereby sacrificing liquidity. Understanding interest rates, inflation, and bonds. Owning a bond is essentially like possessing a stream of future cash payments. Those cash payments are usually made in the form of periodic interest payments and the return of principal when the bond matures. In the absence of credit risk, the risk of default, The value of that stream of future cash payments is a function of your required return based on your inflation expectations. This article breaks down bond pricing, defines the term bond yield, and demonstrates how inflation expectations and interest rates determine the value of a bond. Key takeaways. Bonds are subject to interest rate risk, since rising rates will result in falling prices, and vice versa. Interest rates respond to inflation. When prices in an economy rise, the central bank typically raises its target rate to cool down an overheating economy. 1. Inflation also erodes the real value of a bond's face value, which is a particular concern for longer maturity debts. Because of these linkages, bond prices are quite sensitive to changes in inflation and inflation forecasts. Understanding interest rates, inflation, and the bond market. Measures of risk. There are two primary risks that must be assessed when investing in bonds: interest rate risk and credit risk. Though our focus is on how interest rates affect bond pricing, otherwise known as interest rate risk, a bond investor must also be aware of credit risk. At the May 2022 FOMC meeting, the Fed announced it was raising the federal funds rate by 0.50s, moving its target range to 0.75, 1.0. The Fed expects to continue raising rates in order to bring down inflation. In the lead-up to the May FOMC meeting, the 10-year Treasury yield rise above 3. Interest rate risk is the risk of changes in a bond's price due to changes in prevailing interest rates. Changes in short-term versus long-term interest rates can affect various bonds in different ways, which we'll discuss below. Credit risk, meanwhile, is the risk that the issuer of a bond will not make scheduled interest or principal payments. The probability of a negative credit event or default affects a bond's price. The higher the risk of a negative credit event occurring, the higher the interest rate investors will demand in exchange for assuming that risk. Bonds issued by the U.S. Department of the Treasury to fund the operation of the U.S. government are known as U.S. Treasury bonds. Depending on the time until maturity, they are called bills, notes, or bonds. Investors consider U.S. Treasury bonds to be free of default risk. 2. In other words, investors believe that there is no chance that the U.S. government will default on interest and principal payments on the bonds it issues. For the remainder of this article, we will use U.S. Treasury bonds in our examples, thereby eliminating credit risk from the discussion. Calculating a bond's yield and price. To understand how interest rates affect a bond's price, you must understand the concept of yield. While there are several different types of yield calculations, for the purposes of this article, we will use the yield to maturity (ITM) calculation. A bond's ITM is simply the discount rate that can be used to make the present value of all of a bond's cash flows equal to its price. In other words, a bond's price is the sum of the present value of each cash flow, wherein the present value of each cash flow is calculated using the same discount factor. This discount factor is the yield. When a bond's yield rises, by definition, its price falls. And when a bond's yield falls, by definition, its price increases. A bond's relative yield. The maturity or term of a bond largely affects its yield. To understand this statement, you must understand what is known as the yield curve. The yield curve represents the yield curve. The yield curve represents the ITM of a class of bonds, in this case, Treasury bonds. In most interest rate environments, the longer the term to maturity, the higher the yield will be. This makes intuitive sense because the longer the period of time before cash flow is received, the greater the chance is that the required discount rate or yield will move higher. Inflation expectations determine the investor's yield requirements. Inflation is a bond's worst enemy. Inflation erodes the purchasing power of a bond's future cash flows. Typically, bonds are fixed rate investments. If inflation is increasing or rising prices, the return on a bond is reduced in real terms, meaning adjusted for inflation. For example, if a bond pays a 4's yield and inflation is 3, the bond's real rate of return is 1. In other words, the higher the current rate of inflation and the higher the expected future rates of inflation, the higher the yields will rise across the yield curve, as investors will demand a higher yield to compensate for inflation risk. Note that Treasury inflation, protected securities, TIPS, can be an effective way to offset inflation risk while providing a real rate of return guaranteed by the U.S. government. 3. As a result, Tips can be used to help battle inflation within an investment portfolio, short-term, long-term interest rates, and inflation expectations. Inflation and expectations of future inflation are a function of the dynamics between short-term and long-term interest rates. Worldwide, short-term interest rates are administered by nations' central banks. In the United States, the Federal Reserve's Federal Open Market Committee, FOMC, sets the federal funds rate. 4. Historically, other dollar-denominated short-term interest rates, such as LIBOR or LIBOR, have been highly correlated with the Fed funds rate. The FOMC administers the Fed funds rate to fulfill its dual mandate of promoting economic growth while maintaining price stability. 5. 4. This is not an easy task for the FOMC. There's always debate about the appropriate Fed funds level, and the market forms its own opinions on how well the FOMC is doing. Central banks do not control long-term interest rates. Market forces, supply and demand, determine equilibrium pricing for long-term bonds, which set long-term interest rates. If the bond market believes that the FOMC has set the Fed funds rate too low, expectations of future inflation increase, which means long-term interest rates increase relative to short-term interest rates. The yield curve steepens. If the market believes that the FOMC has set the Fed funds rate too high, the opposite happens, and long-term interest rates decrease relative to short-term interest rates. The yield curve flattens. The timing of a bond's cash flows and interest rates. The timing of a bond's cash flows is important. This includes the bond's term to maturity. If market participants believe that there is higher inflation on the horizon, interest rates and bond yields will rise, and prices will decrease to compensate for the loss of the purchasing power of future cash flows. Bonds with the longest cash flows will see their yields rise and prices fall the most. This should be intuitive if you think about a present value calculation. When you change the discount rate used on a stream of future cash flows, the longer until cash flow is received, the more its present value is affected. The bond market has a measure of price change relative to interest rate changes. This important bond metric is known as duration, the bottom line. Interest rates, bond yields, prices, and inflation expectations correlate with one another. Movements in short-term interest rates, as dictated by a nation's central bank, will affect different bonds with different terms to maturity differently, depending on the market's expectations of future levels of inflation. For example, a change in short-term interest rates that do not affect long-term interest rates will have little effect on a long-term bond's price and yield. However, a change or no change when the market perceives that one is needed in short-term interest rates that affect long-term interest rates can greatly affect a long-term bond's price and yield. Put simply, changes in short-term interest rates have more of an effect on short-term bonds than long-term bonds, and changes in long-term interest rates have an effect on long-term bonds, but not on short-term bonds. The key to understanding how a change in interest rates will affect a certain bond's price and yield is to recognize where on the yield curve that bond lies, the short end or the long end, and to understand the dynamics between short and long-term interest rate. With this knowledge, you can use different measures of duration and convexity to become a seasoned bond market investor. Government bond. What it is, types, pros, and cons. What is a government bond? A government bond is a debt security issued by a government to support government spending and obligations. Government bonds can pay periodic interest payments called coupon payments. Government bonds issued by national governments are often considered low-risk investments since the issuing government backs them. Government bonds issued by a federal government may also be known as sovereign debt. Key takeaways. A government bond represents debt that is issued by a government and sold to investors to support government spending. Some government bonds may pay periodic interest payments. Other government bonds do not pay coupons and are sold at a discount instead. Government bonds are considered low-risk investments since the government backs them. The various types of bonds that are offered by the U.S. Treasury are considered to be among the safest in the world. Because of their relatively low risk, government bonds typically pay low interest rates. 126. Government bond. Government bonds explained. Government bonds are issued by governments to raise money to finance projects or day-to-day operations. The U.S. Treasury Department sells the issued bonds during auctions at regular intervals throughout the year. Only certain registered participants, often large banks, can buy U.S. government bonds directly at auction. When the government holds a bond auction, each buyer submits its purchase bid and the auction continues until all the bonds are duly distributed. Some treasury bonds trade in the secondary market. Individual investors working with a financial institution or broker can buy and sell previously issued bonds through this marketplace. Treasuries are widely available for purchase through the U.S. Treasury brokers and exchange-traded funds, ITCs, which contain a basket of securities. Fixed rate government bonds can have interest rate risk, which occurs when interest rates are rising and investors are holding lower-paying fixed-rate bonds as compared to the market. Also, only select bonds keep up with inflation, which is a measure of price increases throughout the economy. If a fixed-rate government bond pays 2s per year, for example, and prices in the economy rise by 1.5, the investor is earning only 0.5. The investor is earning only 0.5. Municipal government bonds. Local governments may also issue bonds to fund projects such as infrastructure, libraries, or parks. These are known as municipal bonds or munis, and often carry certain tax advantages and exemptions for investors. Munis can be thought of as loans that investors make to local governments, and they are used to fund public works such as parks, libraries, bridges and roads, and other infrastructure. They may be funded via local tax dollars or by revenue generated from the project, e.g., a toll road. Although municipal bonds may have lower interest rates than riskier investments like corporate bonds or stocks, they offer some stability and low default rates. If you are interested in government bonds, you may want to acquaint yourself with the following terms: face or pair value, the amount of debt you are loaning the government and the amount you will get back when the bond matures; coupon, the regular interest payments credited to bondholders; yield, the interest rate on the bond after accounting for its market price; market price, the price of the bond in the secondary market, which may differ from the face value; treasuries, U.S. federal government bonds; T-bill, short-term treasuries, maturing in 1 year or less; note, medium-term treasuries maturing in 2 to 10 years; T-bond, long-term treasuries maturing in 10 to 30 years or longer; TIPS, treasuries that are indexed to inflation, the USUVs; foreign government bonds. U.S. treasuries are nearly as close to risk-free as an investment can get. This low-risk profile is because the issuing government backs the bonds. Government bonds from the U.S. Treasury are some of the most secure worldwide, while those floated by other countries may carry a greater degree of risk. Due to this nearly risk-free nature, market participants and analysts use treasuries as a benchmark in comparing the risk associated with securities. The 10-year treasury bond is also used as a benchmark and guide for interest rates on lending products. Due to their low risk, U.S. treasuries tend to offer lower rates of return relative to equities and corporate bonds. However, government-backed bonds, particularly those in emerging markets, can carry risks that include country risk, political risk, and central bank risk, including whether the banking system is solvent. Investors saw a bleak reminder of how risky some government bonds can be during the Asian financial crisis of 1997 and 1998. During this crisis, several Asian nations were forced to devalue their currency, which sent reverberations around the globe. The crisis even caused Russia to default on its debt. The uses of government bonds. Government bonds assist in funding deficits in the federal budget and are used to raise capital for various projects, such as infrastructure spending. However, government bonds are also used by the Federal Reserve Bank to control the nation's money supply. When the Federal Reserve repurchases U.S. government bonds, the money supply increases throughout the economy as sellers receive funds to spend or invest in the market. Any funds deposited into banks are, in turn, used by those financial institutions to loan to companies and individuals, further boosting economic activity. Pros and cons of government bonds. As with all investments, government bonds provide both benefits and disadvantages to the bondholder. On the upside, these debt securities tend to return a steady stream of interest income. However, this return is usually lower than other products on the market due to the reduced level of risk involved in their investments. The market for U.S. government bonds is very liquid, allowing the holder to resell them on the secondary bond market easily. There are even ETFs and mutual funds that focus their investment on treasury bonds. Fixed-rate bonds may fall behind during periods of increasing inflation or rising market interest rates. Also, foreign bonds are exposed to sovereign or governmental risk, changes in currency rates, and have a higher risk of default. Some U.S. Treasury bonds are free of state and federal taxes. However, the investor of foreign bonds may face taxes on income from these foreign investments. Examples of U.S. government bonds. There are various types of bonds offered by the U.S. Treasury that have various maturities. In addition, some bonds return regular interest payments, while some do not. In the U.S., the national debt refers largely to the notional value of outstanding government bonds. The largest portion of the national debt, approximately $24.02 trillion, is held by the public. Intragovernmental holdings make up approximately $6.06 trillion for a total debt of approximately $30.09 trillion as of CRE 2022. 1. Savings bonds. The U.S. Treasury offers Series E bonds and Series I savings bonds. Bonds sell at face value and have a fixed rate of interest. Bonds held for 20 years will reach their face value and effectively double. Series I bonds receive a semi-annually calculated secondary rate tied to an inflation rate. Treasury notes. Treasury notes, T-notes, are intermediate term bonds maturing in 2, 3, 5, or 10 years that provide fixed coupon returns. T-notes typically have a $1,000 face value. However, 2 or 3 year maturities have a $5,000 face value. Treasury bonds. Treasury bonds, T-bonds, are long-term bonds having a maturity between 10 to 30 years. T-bonds give interest or coupon payments semi-annually and have $1,000 face values. The bonds help to offset shortfalls in the federal budget. Also, they help to regulate the nation's money supply and execute U.S. monetary policy. Treasury inflation. Protected securities, TIPS. Treasury inflation, protected securities, TIPS, are a Treasury security indexed to inflation. They protect investors from the adverse effects of rising prices. The par value, principal, increases with inflation and decreases with deflation following the Consumer Price Index (PI). TIPS pay a fixed rate of interest determined on the bond's auction on a 6-month basis. However, interest payment amounts vary since the rate applies to the adjusted principal value of the bond. TIPS have maturities of 5, 10, and 30 years. On NAVA years. On NAVA 19-2020, the 10-year TIPS bond was auctioned with an interest rate of 0.867. Buying these trading bonds. If you buy government bonds and hold them until maturity, you will enjoy regular coupon, interest, payments, and a return of your initial investment when they mature. During that time, however, the price of a government bond will fluctuate in the market. Bond prices have an inverse relationship with interest rates. So when interest rates go up, government bond prices go down in the secondary market. Because of this, shorter-term investors who do not buy and hold bonds until maturity can experience gains or losses in the market. Bond traders can also look to profit from the relative differences in the yields of certain bonds, known as the spread. For instance, the spread between U.S. Treasuries and highly rated corporate bonds. Another bond trading strategy is to bet on changes in the spread between different maturities, known as the yield curve. Government bonds can provide a combination of considerable safety and relatively high returns. However, investors need to be aware that governments sometimes lack the ability or willingness to pay back their debts. How do you buy government bonds? U.S. Treasury securities are available to investors through their broker or bank or directly through the Treasury Direct website. Investors can also look to ETFs or mutual funds that invest in treasuries. Municipal bonds are available via your broker. How do government bonds work? When governments need to raise funds for operations, e.g. paying government employees or servicing interest charges on existing debt, or to invest in projects, e.g. building federal highways, they can sell bonds to investors. In the U.S. case, bonds are sold through the Treasury and represent debt owned by bondholders. These bondholders are credited with interest and a return of their principal when the bond matures. This makes bondholders of treasuries essentially creditors, lenders to the federal government. Why are interest rates on government bonds usually lower than other bonds? Bonds issued by the federal government are considered to be essentially riskless. In the U.S., the federal government has never defaulted on its debt, and the government could theoretically create more money or raise taxes in order to pay for the interest on existing debts to avoid default. Therefore, treasuries carry what is known as the risk, free rate of return. Corporate and other bonds must carry higher yields to compensate investors for the additional credit risk that are inherent to them. What are U.S. government bond types? The U.S. government has a variety of different Treasury securities available for purchase depending on what the investor is looking for. The different offerings of the securities are Treasury bills, Treasury notes, Treasury bonds, Treasury inflation, protected securities TFs, floating rate notes, FRUNs, Series E savings bonds, and Series E savings bonds. What are examples of non-U.S. government bonds? Foreign governments around the world issue debt in the form of bonds. Some of these commonly include the UK, gilts, Germany, bunds, France, oats, Japan, jabes, Italy, pizzis, Canada, Canada bonds. The bottom line. Government bonds issued by federal governments are among the safest investments around, often carrying the risk-free rate of return. However, because of their lower risk, they also carry relatively lower yield. In the U.S., federal bonds are known as treasuries, which consist of short-term ET bills, medium-term E notes, and long-term E bonds. Foreign governments also regularly issue bonds. State and local governments may also issue bonds in the form of municipal bonds, munis. These are attractive to some investors since they can offer certain tax exemptions.